I'm Jamie. This is George. We're the Storage Bros. And this is The Storage Hustle, episode 4. This is the podcast where we tell you how to turn containers into cash flow.
We are most definitely not financial advisors.
Yeah.
Far from it.
Yeah. Disclaimer.
Oh yeah, I have people that not in Storage Bros, but like in other industries being like, can you get me a bit of that? Can you get me some of that?
We sell storage to make money. They're in the business of selling debt to make money.
And to this day, I'm still like, I don't actually understand.
Straight into episode 4 with no 6-month break.
No. That's what we do now. The new HQ.
The new HQ.
Yeah.
Unit 3.
Unit 3.
Everyone knows what Unit 3 is.
If you don't know what Unit 3 is, go back and listen to episode 3.
Yeah, and we'll tell you all about Unit 3, Unit 1, Unit 2, and Unit 3. So episode 3, we got everyone up to speed on what we've been up to for the past 6 or so months, which is basically some quite rapid expansion.
Yeah.
Which has been fun. It's kept us on our toes.
Yeah, it definitely has. It's been like every time we think, right, we're at where we're at now. Let's just kind of, that's it, right? And then it's like, well, no, that's not it, is it? There's got to be something else.
Yeah, this is the thing. So let's maybe start off by going into the irony of basically, let's do a little cap on what this episode is going to be about. It is going to be what we spoke about in the last episode, which is catching everyone up to where we are now. Some pretty rapid expansion. This episode is going to be about how we financed said expansion, right?
Yeah.
Which is going to be, that was fairly new to us, wasn't it? But just to go back onto the irony of what we're doing, and the whole podcast is called Containers into Cashflow.
Oh yeah, I didn't know you were going with that.
Right, okay.
Yeah. No,
Containers into Cashflow, and that's literally why we started the business, right? Is that we wanted to start a positive cash flowing business, I guess, for our own personal cash flow, right?
Yeah.
But what's happened over the years is that every time we reach a, let's say, plateau, there's been another opportunity ahead of us, which has basically meant that we've doubled down every time. So every time that we've had accumulated profits, we've just invested them straight back into the business.
Yeah, and I think this is why this is quite an important subject for us, isn't it? Because every time that's happened, it's actually come at a really bad time for us financially.
Yes.
Where we've already either just doubled down on something else, then another opportunity comes along that we know if we don't take now, we're going to be kicking ourselves in 6 months' time that we didn't take it.
Yeah.
Which is kind of leading us into when the cash flow isn't there, what do you do?
Yeah, that's right. So So when it was fine when we expanded after about a year. It was after about a year we expanded because we had basically had, because one of the worst places to be actually is when we're completely full.
Yeah.
Because we always have this feeling of almost like being stuck, because we went through a phase of like looking at other sites and we went on site viewings. If you've seen our TikTok, you'll see us going to various different site viewings, meeting different landlords and speaking with agents and things like that. So there's nothing more frustrating than when we're full.
Yeah, it's weird. I think you said this in a TikTok once. You're like, there's something quite ironic about it. A storage company with no storage.
Yeah. And when people get in contact, which is fairly regularly, and say, "Can we have a storage unit, please?"
Yeah,
ain't got any storage. I'm really sorry.
No, but
and that's painful. That's
yeah, and we know what happens with them. They don't go, "Oh, can we join your waiting list and we'll take one in 6 months' time." They need it there and then, right? So that's goes back to something else we've spoken about before.
Yeah, they'll go to a competitor, even if it's not directly in the area. They'll go next town along, or next population along. Like they'll make it work. It's one of those storage. If our customers need storage right there and then, it's not something that they've been thinking about. It's like, I need storage. I haven't got any space.
So this is the thing. So realistically, we started this business because it was not advertised, after we'd done the research, as a high cash flowing business, which is true. Yeah, that is very true. That is not to be forgotten.
Yeah.
But obviously, with expansion it comes more investment and more capital needed, basically.
Yeah.
And what would you say, like, if I was to say to you, I need money, what would you do to get it? I know how you get it because we've got it, but what's like the generic ways of doing it?
What, to raise finance?
Yeah.
To raise finance in this specific industry?
Yeah.
So I guess there's a few options, right? There's leverage, which is borrowing the money, or there's investment, which is essentially selling equity to raise money for the company for it to be reinvested.
Yeah.
For expansion, for it could be a number of things, couldn't it? It could be for capital investment, it could be for equipment, it could be for a vehicle or vehicles, it could be for plant, it could be for acquiring a new premises, it could be cash flow, it could be anything, right? In our case, it's been I guess acquiring new sites.
Yeah.
And it's assets.
I was going to say, because realistically, like when it comes to double down and going again, actually it kind of comes around that the actual land and getting the land and the yard itself isn't the big killer. The killer is, right, cool, we got the yard. Yeah. It's empty. You've got to get however many units you've got to get down. And depending on the different ways of financing the units, where we've spoke before, where you can either rent them, finance them from whoever you're buying them from, or buy them outright. We decided that it's been better for us to buy them outright.
Yes.
Which then obviously then says, right, well, we need 60 grand now to be able to fill this yard.
Yeah.
And it's going about how to do that. And we've had chats with investors, haven't we?
Yeah.
So that's been something really interesting. Yeah. And we've had multiple people come through to us from the podcast, from our socials and whatnot. And we've had some serious sit downs, and it's been quite scary, isn't it?
Yeah. You get to a point where obviously the good thing about our business is that it's solid.
Yes.
It's good business.
Yeah.
Very investable business. I guess we've had some relatively advanced conversations with financiers, investors. We've explored different routes since that are more suited to us, and that's more down the finance route.
Yeah, I think that's important as well. So, like, what might work for us might not work for someone else. So,
100%. And it depends on what your expansion plans are.
We are most definitely not financial advisors.
Yeah.
Far from it.
Yeah. Disclaimer: we're not financial advisors.
No.
We're just telling you what we did.
Yeah.
And what we have done, and what we'll potentially continue to do.
So, what did we do?
So, we decided to go down the lending route, so the leverage route, and there were two options presented to us. One that was not fairly obvious, but something that had sprung to mind before, and that was asset finance. We have a good relationship with some financial brokers. What they'll do is that they will go out, they will assess your business, assess the performance of your business, assess us as directors, and they will go out to various different lenders, and they will work out whether we can raise finance or whether we can borrow money in order to fund our expansion. Now, the great thing about containers is that they're considered assets. So we haven't gone out there, we haven't been looking for a business loan. We have raised the capital to fund our expansion via asset finance, which are two very different things, because they're two different products that are wildly different price-wise. So if you're borrowing money, at the end of the day, it's going to cost you money to borrow money, right? And that's the interest rate.
Sure.
So a business loan, very spicy. Very, very spicy in terms of interest rates, right? Asset finance, it's a little bit different. So our broker has managed to find a lender, several lenders that actually see containers as hard assets. So that's essentially, basically, so it reduces the interest rate, because according to the lender, if anything goes wrong, they can just come and collect the assets. They can just come and pick them up.
Yeah, of course.
They will hold a value over the next however many years. So the risk to that lender is a lot lower than if, say, we wanted a business loan for cash flow. So let's say that they were lending us 60 grand for cash flow to, acquire a site or to grow our stock or something like that. The interest rate would be much, much higher because they've got little or less security. But in this instance, we've raised 40 containers? 40 containers?
In total, probably, yeah.
About 40 odd containers we have raised finance against the assets. So we've asset financed about 40-ish containers.
Yeah.
And we've got about another 10 to go.
Yeah.
10-ish.
And then we're full.
And then
and then we go again.
And then we go again. We'll see what else happens. But we did do a raise before the asset finance.
Yeah, so I think let's go through, like, because we've been doing this now for, I say we, you've been doing this now. So this podcast obviously as well is going to be, I'm going to try and interview Jamie Bander, right? Because Jamie did the majority of it, but I was there for moral support. So I think, like, it's important. Let's go through the stages from when we did the first one, and that was actually a slightly different loan, wasn't it? In terms of
that was different.
It wasn't really an asset finance. That was completely separate. So I think let's talk through the journey of our first one. How many have we done now? 3. We've done 3. Haven't we?
Three raises.
3.
3.
So we've done 3. So first one, second one, third one, to where we're at now. Looking like we're going to go again.
Yeah.
Early next year. So talk us through the first one, what that was, how we came about it, and just how it kind of all works.
So the first money that we raised, which was just shy of 50 grand. Yeah, that's right, isn't it?
It was
just shy of 50 grand, right? That was the first money that we raised for this company, for this business, right? Prior to that, it's been, as you'll know from previous episodes, it's been our own cash from retained profits from other businesses, and it's been retained profits from this business, accumulated profits. So, and I think this is why it's important to speak to a broker, financial broker, a financial advisor, because they will give you knowledge that you wouldn't have thought of, right? So the way that we raised the first 50, let's call it 50 grand, it was just shy, wasn't it? I think it was 40, I think it was 45.
Yeah, so 20 odd each was something like that.
Yeah. 22 and a half each, right?
Yeah.
And we say each, I'll go into that, right? So it was actually a startup loan from the British Business Bank. And it's essentially the cheapest money that you can get. So it has a fixed interest rate of 6% annually, which is wild.
Oh yeah, I have people that not in storage pros, but like in other industries, being like, "Can you get me a bit of that? Can you get me some of that?" I want like dying for 6%.
Yeah, because 6%, because assets, an asset, a hard asset is typically 8.8%, 8.9%, and then you go into the realms of cash flow loans. And
we went into that a little bit, didn't we?
Yeah, we did. We
had to.
And you're talking high 20s, 27, 28%. Spicy stuff. So that gives a good idea of the comparison of what the startup loan is and what the British Business Bank are offering. It's a little bit different in the sense that there's quite a few hoops that we needed to jump through, right? So I'll give a brief synopsis of what a startup loan is. The British Business Bank, they will lend up to £25,000 per director to a company that has been trading for 3 or less years, or I think it might be less than 3 years. You have to hit certain criteria. Well, no, that is the only criteria, actually.
Yeah.
It's like you need to be a director of a company that has been trading for less than 3 years.
Yeah.
I think there might be a revenue cap as well.
I can't remember.
There might be something like that. But that's the basic bones of it. And then that is the eligibility, right? So you can do it post-revenue, you can do it pre-revenue or post-revenue. obviously you have to apply, right? So it has to go to an underwriter, and then you have to apply. So whether you're pre or post revenue, obviously look, if you're post revenue, you're already trading. That is obviously going to help your application. But again, similarly, if you're pre revenue and you've got a robust business plan, it's not something that you can't do. So what we had to do is we applied. There's a credit search on us individually. That's the first.
Yeah, because this one threw me off a bit, because it's actually a personal loan for business use.
Yes.
Yeah.
Yes. So it is a personal. Exactly that. It's a personal loan on the basis that you will then invest the money into the company that you're applying for via your director's loan account. And I guess your director's loan account is essentially any money that me or you, or that you as a director has loaned the company for whatever reason. Majoritively it's startup costs, right?
Yeah.
So then that goes against your director's loan account. So essentially the company owes you that money, right? So that's essentially what the criteria is that it's a personal loan for yourself and myself as the director of the company. We then inject it into the company. So that's why there's the credit searches. So there's we had to pass the initial credit search, which was all your usual kind of documents. Like they have all the data from, it's like Experian and Equifax and whatever. So then that's hurdle number one. So we both applied, and then that took 24 hours?
Yeah, and to be fair, like I was worried because I keep thinking that my credit's probably not the best.
Same.
And I definitely haven't got like healthy bank accounts. So
yeah.
There's a worry, isn't there, when you do this stuff? But actually, like it's not really something you should worry about.
Yeah. I mean, look, obviously,
to an extent.
Yeah,
like,
sorry. If you're like riddled in CCJs and and I don't know, like you've got the feds are after you. Like, I would obviously you're probably not going to get past that stage. But like you said, like me and you are not straight A students when it comes to credit.
No,
we're not. We're okay. There's been times in the past, maybe when we were younger, like we've been in a worse state credit wise. But so. Essentially, that's the first hurdle, right? So to get through the personal credit search, that took about a day. So you apply online, took about a day. You basically get a conditional yes or no. We both got yeses, which was great, which means that you move to the next stage of the application, which is you get assigned essentially like an account manager. He's like not an underwriter. He wasn't an underwriter, was he? He was he basically what he did. He worked for a firm. I can't remember the name.
I can't remember.
An independent firm
Yeah.
that's obviously appointed by the British Business Bank to essentially assess all of the applications, get all of the information that we need in order to present it as well as possible, in order for the underwriter to then go yes or no.
Yeah.
Basically. So that was the longest stage, and it probably took us about 3 weeks. First thing that needs to do is that we needed to write a business plan. But the good thing is they give you a template.
Yeah.
So they give you a template that basically you're required to essentially fill it in. So they ask you various different questions about the business, about your target audience, about your customer base, about your area, about your revenue and numbers, but then also about our experience as directors, what is our background, et cetera, et cetera. All, it sounds like a lot, but actually you just work through it systematically. And it probably took a day, 2 days, 3 solid days to really to get through it.
Yeah.
And then you've got a 1 year cash flow forecast. And then we had a personal budget to do, right? So that was our personal. So our personal ingoings and outgoings, we basically had to list them on a spreadsheet, and then we had to also submit bank statements. So it all correlated. And then we essentially had to do the same thing for the business, which is what the cash flow forecast is, right? So it's like, this is how much we pay in rent. This is how much revenue we're making. In our case, because we're post-revenue. And then it basically spits it out of like, this is your cash position. This is what happens when you inject 40 grand up to 50 grand. And basically the aim of the game was, 'cause it's kind of like a game on the bottom of the spreadsheet, is to just make sure it's not red.
Yeah.
Make sure it's in the black.
Yeah.
So, but it's good because our account manager works with us through that. We submitted it once and then wait for their feedback, and then we would make tweaks, and we'd had phone calls with them. Like, it was super, super helpful.
And for us, it turned out really lucky because he lived in the area.
He lived in the area.
We didn't have a clue because they're actually based, I want to say Leeds, but I don't think that's true.
Something like that.
Somewhere up north.
Yeah. But our account manager was based in New Haven.
So he knew that's what really helped. And I think we just got lucky there because he knew what we were talking about.
Yeah.
He knew the area. He knew.
He'd literally driven past before.
He'd driven past, yeah.
He knows that we're here as well.
Yeah.
So I think ultimately that probably did help.
Yeah.
And he was just a nice, down-to-earth guy. Like, it wasn't like speaking to a bank. It was like speaking to a guy that had genuine knowledge, knew how to package up all the information. And then essentially that's what we did after about the 3 weeks.
But I think that's what makes this process really scary.
Yeah.
Not having done this before, and there'll be loads of people that have never done this before.
Yeah.
And I have loads of people who have done it before, and they just make it seem like it's just an every other Tuesday that they've just gone and borrowed X amount of money, when actually it's not as daunting as you think it is.
No, it's not. I think the key thing is you just got to work through it. It's just a process, right?
Yeah.
And it doesn't matter that you've never done it before. Like, we had never gone through this process before.
Yeah. And I also think like something like that, I thought personally, never be achievable. Like, why would someone want to give us 50 grand towards our business? Didn't make sense to me. But now it's like, it does make sense though, because I know it's a good business.
Yeah,
on paper, it's a good business. I know that.
Yeah.
But it's a weird thought to think, why would someone do that? So I don't think that should stop people from just doing it, because it probably would have
100%.
stopped me from doing it without you, to be honest.
Yeah, 100%. I think the key thing to remember is, right, without getting too deep into like how money works and how finance works, but you got to look at banks and lenders as we sell storage to make money. They're in the business of selling debt to make money.
Yeah.
So we're a sale to them. So as much as like it's a weird mindset to be in. Like, I think before this experience, my mindset of like borrowing money was almost like, please, sir. Like,
you know what
I mean? Like,
no, it's true though.
Can I have some money?
It's true, because
Like,
that's what it feels like.
that's what it feels like.
Yeah.
But when you go through a process like this, and obviously fast forward a little bit, and I'll fill in the blanks. We got accepted for the bounce back loan. It's a really validating feeling, and once you kind of understand that actually it's a symbiotic relationship where we're the lender. Sorry, not yet. we're the borrower, right? And they are the lender, but that is their product. So essentially, they just made a sale. And how good do you feel when we make a sale?
Oh, mate, buzzing.
Just made a sale.
Yeah,
buzzing.
we made a sale today. Yeah.
It's a similar kind of thing. So I guess, to go back to what you were saying about people, that feel a bit daunted by it, try and keep that in mind, one. And two, remember that it is a process, and it might feel daunting because it feels like a big thing, but then what this process does is it actually breaks it down into really achievable chunks.
It absolutely does. No, you're so right.
It was like, literally like having one-to-one support
Yeah.
on how to successfully raise this money.
Yeah, and that's important.
Yeah. Because to be honest, if we were doing it, just on our own, just off our own backs with maybe, I don't know, like a chat support, or you can email someone if you're stuck, would have been a different process. It would have probably felt a lot more, I don't know, like on edge, like, well, we can't make a mistake.
Yeah.
Whereas we had that account manager to submit. If it was wrong, he would then tell you what's wrong.
That definitely happened. Like, I think
Yeah.
I did a few things wrong. I think I did my personal budget wrong.
Yeah. I did
And
as well.
he hits us back saying, no, this doesn't quite look right.
This is what they'll say if you
Yeah.
had submitted like this, so we need to change it to this. And then he would ask questions to get the right information out of us. And then once we'd got everything in order, he didn't, obviously, because he can't say the words like, yes, you're guaranteed to be accepted. He used terminology like, look, this is literally my job to get these to a place where they're ready to submit and ready to be accepted. We would not have made it through to that stage with our account manager if we weren't going to be accepted.
Yes.
So as we kind of closed in the finish line, and then it was a case of like, I remember when I was sat in a car park in wherever I was I had to get my laptop out because we had to submit it.
Yeah.
Made those few tweaks to the cash flow forecast whilst he was on the phone. And then he said to me, he's like, right, if you get this to me before the end of play, it's probably about 3 o'clock by this point, or 2 o'clock, before the end of play today, we'll get it submitted and the money would be in your account in 24 hours.
Yeah. So that's the next mad bit, isn't it? Right.
I was like, what?
So then and I think it just happened one afternoon. I think I was driving through London at the time.
Yeah.
And, a ping comes in your phone and it's just like, oh, it's 22.5 grand just landed in my account.
Yeah.
And then
you
like,
to a Monzo.
Yeah.
Because obviously it comes in. So because it's a personal loan, it comes into our personal accounts.
Correct.
And then obviously then we, like I said, we then invest it into the company. But yeah, like
you
just get a ping like was it on your Monzo?
No, I think mine was just on my normal bank.
Oh yeah. My Monzo just pinged up.
It's crazy. And then that just like it's a feeling of relief.
Yeah.
Not relief, because it's like the business is still doing well. Let's be clear about that. The business does well as it stands, but it just means that now we can then double down, go again, even harder than we ever have done. Because previously, like you said, it just been from cash flows and profits of previous things. So that then gives you the confidence to do it again. Which it's like, I feel like now we talk about it, I'm just like, oh yeah, we just done another one.
Yeah.
Like, and now so we're on number 3. These number 2 and number 3 raises slightly different.
Slightly different, yeah.
And these blew my mind. And like, I remember you were telling me about it. And so these are going to be asset finance.
Yes. So yeah, what we did after that was asset finance.
Right.
So we could have asset finance from the get-go, but essentially our broker was just like, take this money. It's the cheapest money you get. Oh, another caveat to startup loan is that it's once in a lifetime.
Oh yeah, true.
Per director, true. It's once in a lifetime.
Is it up to 4 directors or no?
I think there's a limit on how many directors can raise on one business.
But it's up to 25 grand per director.
Oh my God. So it's up to 25 grand per director. And then 3 weeks later, that got raised.
Oh, it did, didn't it?
It was like, what was it? I can't remember what it to, but it was like it took it to like 33 or 32. We'll have to look it up. Like, don't quote me on that. But literally like 3 weeks later, the threshold went up, didn't it?
We were still happy. We were still happy. And we were out shopping for shipping containers.
100%, because it was 45 grand in the bank that we didn't have before.
Correct.
And that was a barrier to us moving forwards was cash. So just going back to the business owner, it was that was a caveat. So it's once in a lifetime. So now, for example, even if me and you were to go and start up another company even if it's a completely different industry, we wouldn't qualify for a startup loan because we've basically already had it.
Well, it makes sense. I get it.
Because otherwise, you could just keep doing it, right?
Yeah.
Because if it's based on you and the strength of the business, then technically you could just keep doing it forever, which obviously that's not really fair. It doesn't make sense. Well, you wouldn't grumble, would you? So that was our broker was just like, look, do this first because you'd be silly not to. It's what I advise most people. So we went and gone that, and we were like, right, complete it, mate.
Yeah.
Now
spent it.
It's already gone.
We need more, please. That's when it comes back to the please.
Yeah, we need more. Actually, just going back quickly to the startup loan, it's different to a asset finance and a regular loan because you have to drill down into we had to list exactly what we were going to buy with the 45 grand.
Oh yeah, we did,
and we had to provide quotes or pro forma invoices from our suppliers that literally added up to the pound what we were borrowing. So if there was any discrepancies, we had to change it. So what we then did next was we asset financed.
How many was it?
16. 16 containers. But the really clever thing is that we raised the money from the British Business Bank. We then bought outright 8 containers.
Yeah.
And then we also bought some other stuff. We had some fencing to buy. We had some signage to buy. We had some... What else did we buy? Just some...
I upgraded our CCTV points as well. Yeah.
We made some upgrades. So what the great thing about that is because we owned those assets outright, we were able to refinance them. So essentially, we doubled down on those 8 units, which was roughly 20
something,
20 odd
late
grand,
20s.
like late 20s. So because they were less than 3 months old, which they were brand new, they'd just landed. Our broker was like, "That's cool. We can just pull the cash out of that. We can just refinance those." We were like,
"No." So I genuinely,
and
to this day, I'm still like, I don't actually understand. But you know, that's what partnership is, right? And that's
yeah, I guess so. Yeah,
it's now.
It's now. But so the broker explained that. I was just like, brilliant.
Yeah.
And he was, we were like, well, we need another 16 at that point, wasn't it, to finish off unit 1.
Mm-hmm.
So that enabled us to essentially double down. So we refinanced the 8 that we had just bought
with the British Business Bank.
Yeah. So that's bang. That's 8 sorted. And then we asset financed the other 8.
Yeah.
So then, so that's an additional 16 units. And I guess in terms of asset finance, the process was, in hindsight, it's a lot more straightforward than the British Business Bank. Like I said, there's a lot of hoops to jump through. But I think, in essence, I think a business plan is pretty key and integral to any kind of business, even one that we've been running already for 2 years. I think it's still a really good process to go through so you can understand it. And again, off the back of it, once we were out the other end and we'd successfully raised the money, it gives a real good sense of validation. You're like, we've been sitting and telling people storage is a good business for 4 episodes now.
Yeah.
But now it's like, there was definitely a sense of validation, and that it's like, oh
yeah, absolutely,
it is good business, does do its thing. So the asset finance was more a case of we had to produce invoices for the assets that we were refinancing. Then we had to produce the pro forma invoices for the assets that we wanted to raise. The broker then went to work to then find the best lender, and then his job was to find lenders that would see containers as a hard asset, because it lowers the rates, right? And like I said before, what that basically means is that the lender has more security because they can, if anything goes wrong, if we go into liquidation, something bad happens, they obviously have a claim over those assets. They can just come, identify them, pick them up and say, those are ours now.
Yeah.
And they'll mitigate their losses, right? Or reduce their losses. So essentially, from our point of view, in terms of an asset finance raise, what did we produce? We had to produce bank statements, business bank statements.
Yeah.
So 6 months business bank statements. We had to produce a balance sheet and a profit and loss. We did.
It was a balance sheet and a profit and loss.
Balance sheet and a profit and loss.
Yeah.
All 3 of these things are relatively easy to produce.
If you've been carrying on with your bookkeeping.
If you've been carrying on with your bookkeeping, introducing our bookkeeper, George Layton. So George has taught himself Xero accounting software. Yeah. For years.
Yeah.
For years we have been paying accountants,
correct,
obscene amounts of money to do. Listen, there are obviously certain things that we rely on our accountants to do because it's outside of our skill set, remit, etc. But George taught himself Xero, how to bookkeep, how to submit VAT returns. In what did it take you? A couple of months?
Yeah. Again, that's one of those things that seems super daunting, right? But I could talk about this all day long, and we're not going to go too much into it because I will talk about how the education system is flawed. But
don't get me started.
No, I know. So luckily we live in a day, and there is software out there that can help you with all these things, and it's super easy. And I think we realised it very quickly because we're not a really high transactional business. We know exactly what's coming in, and we know pretty much exactly what's going out. So it just seemed a no-brainer to figure it all out ourselves. So
that's right.
And then it's just literally a click of a couple of buttons to get a P&L and a balance sheet, which blew my mind because
mental.
We're paying people in offices to do that. It's crazy.
Yeah.
No offense if you're an accountant that is listening.
Yeah.
To this episode.
And accountants they are very important.
Oh my God! Like there are certain things that I will not do.
Yeah.
Because I will mess it up.
Exactly.
Yeah.
But that I guess that's the thing. Like you taught yourself a skill set. There's software like Xero that we use, and then there's the whole of YouTube that will teach you how to do it.
That's also it.
It's like the best place to learn, right?
So what else did we have? So that kind of covers the balance sheet and profit and loss.
Profit and loss, which obviously you just pulled off Xero.
Yeah.
Obviously we had to make sure that it was all in check and actually did make sense, which it did. And essentially, from that point onwards, the broker then goes to work.
Yes.
So the broker goes to work, and the broker does a lot of the hard work. They're the one that is approaching lenders,
but this is
presenting us to lenders.
To the point where we had 2 brokers.
Yeah, we had 2 brokers.
We had 2 brokers going at one time, and we were kind of, I don't know if that's necessarily the best way to do it, but I actually came by accident.
That's right.
Because where we were purchasing the unit said, oh, you can speak to our broker, but we already had our broker and he was also working on it. So that actually didn't come from us trying to be like annoying.
Yeah. We took the view of like, well, let's have 2 brokers working on it and whoever comes back first with the best rate wins.
But it definitely incentivized someone to do it much quicker.
Yeah, it did. Yeah. It did. I think in the end, when it got down to, when it got actually down to it, it was basically it was going out to the same lenders, just from 2 different sides. So then the lenders were like, what's going on here?
So we did kind of shoot ourselves in the foot.
Yeah.
Because we had 2 applications for the same thing, same people, same businesses.
Yeah.
Everyone was a bit confused.
Lenders were like, what's going on? So basically we were just like, right, you initial broker, like you crack on.
Yeah.
So essentially like it's a relatively straightforward process, so long as your numbers and your business can actually back it up, because they'll do a full assessment, right? So for example, if we were trading at a loss, or if we were insolvent, or if we weren't producing a bottom line, if we didn't have X amount of revenue, then obviously it would have failed. But clearly, those things were all in check, and essentially it was a relatively straightforward process. So then what happens from that point is then in the first instance, because we were refinancing those 8 units, the lender paid that directly to us. Yeah. And then on the other 8 units that we financed at the time, the lender then pays the supplier directly, right?
Yeah.
But they pay the net value, so not including the VAT. So essentially, we then pay the VAT on the total amount, which we can, of course, then claim back. Yeah,
which we kind of learned the hard way a little bit, because I think we got quite excited about this is going to be great and we don't need anything. They can just pay for it in happy days. But actually, it turned out, we did need.
Yeah. So we did have
something.
I guess you can look at it as a deposit. So it's like we can't just do this without spending any money. Money does need to leave our account. It's for the VAT. But of course, we can claim that back. It's just, you've just got to make sure from a cash flow perspective, 1, you have the cash in the bank to pay for the VAT. And 2, it's not going to make too much of an impact on your cash flow, because you can't claim that back for at least 3 months. In our case, it's going to be longer than that, because we are not yet VAT registered.
No.
Which we will be. And I think we'll do a whole separate episode on, on VAT.
Yeah, absolutely.
So put a pin in that one. But yeah, so essentially that's essentially the crux of the asset finance, right? So
and I guess that was quite fun actually. Well, I say fun. There's a weird way of fun. Like no, because I've got Scott at Unit Group saying these aren't paid yet, mate. And I've got our broker talking to the lender being like, no, lender says it's paid.
Yeah.
And we're like, oh, I don't know what to do now.
Yeah.
Now it's like back and forth. No, it's been paid. No, it hasn't been paid. Oh, it has been paid. And then I think like it took a couple of days for it to actually kind of land and be found and be kind of put to where it needed to be. But it got there in the end. It
got there in the end. And I think it was a process that, we've now gone through.
And this is all in the midst of us needing units, because we'd already sold some of them.
Yeah,
like literally. We mentioned in the previous episode.
Yeah. We had 2 or 3 bookings.
Yeah.
This was on a Tuesday. We had bookings checking in on a Friday.
Yeah.
And we didn't have units.
No, so that's what I mean. That was why it's a bit stressful, that part. Then I guess like we've spoken about how we've done it. if we rewind it all the way back to the kind of near towards the beginning where we were sat down with an investor, and there were some really interesting things that were said in that conversation, and one of them that rings quite clear to me, and I think resonates with you as well, where we were looking at a ginormous site of 120 odd units, and obviously for that we were going to have to sell a portion of the business to this investor. That investor turned around and said, just don't ever sell or ask for any money until you need it, basically, because at the time we didn't have this new yard. We weren't in a position where we needed it. We wanted it.
We wanted it.
And
we
got
wanted
told,
to expand.
Don't take this money unless you need it.
Yeah.
And that kind of, it was weird. It was quite a chilling moment, but that was a really nice conversation as well. And that's, I think, also really a good thing to say, is that all these investors out there aren't as scary as you might think. There probably are some out there that are pretty brutal, but
of course. Yeah.
What would you, talking through that part of it, if you were to go down that route, what would you say pros and cons are for going down that route of investor instead of asset finance or bridge loans?
Well, you nailed it by saying like you've got to need the investment, not just because you want it. I guess there's pros and cons to it in a sense that I can't answer this question for sure, but I think it would have been harder for us to raise capital in the way that we have done through debt at that stage of our journey. I probably think that, okay, we weren't pre-revenue, but we were relatively small.
Oh, mate, tiny.
The operation was small,
right?
Yeah. So I don't know. Like if we'd have gone down the route of borrowing at that stage, how successful would we have been? I don't know. So it's a tough one to call, and it suits different things. Like I guess the thing is about borrowing is that you need to have the cash flow to sustain the debt, because we are on repayments, right? That's how it works.
Yeah.
If we had went and we sold equity in our company for a stake, and we'd taken on some investment, there's no repayments each month. It's whatever you've negotiated. It's once the company has reached X level of maturity, then it's paying back out of net profits, or it's an exit strategy. So the company gets sold, and then that's where everyone gets their money back, 5x, 10x, whatever it is, right? So you don't have the pressure of monthly repayments. So those, I think, are the pros and cons.
But you have a different kind of pressure.
You have a different, you have a different kind of pressure. You have a business partner. It won't be two bros. It'll be a third bro or sis. True. It would be. It would no longer be just us, which is whether that's a good thing or a bad thing, whether that's a pro or a con, I don't know.
But I think at this point of the business, it kind of defeats the object as to what we started this for.
Yeah.
Not that I'm saying we started a business just for us to keep 100%. And one day that might come a day where we think it's right to actually part with part of it. But at that moment in time, looking back now, I'm just so happy we didn't do that. It makes so much sense.
Yeah, because we've got complete ownership now. We can still make our own decisions. Like, yes, we've got the pressure of cash flow. And I think, to be honest, we probably do a whole episode on cash flow and managing cash flow, because it's one of the hardest things about this business is managing your cash flow. Yeah. And I think, going forwards, looking back, I think we've made the right decision.
I absolutely agree.
And I think we're in a good place. It's just about managing the cash flow now. that's the
easy
fun
bit.
part.
Yeah,
the easy bit. That kind of I guess that wraps up how we've funded our expansion up until now. Leverage.
And I think it's important to say that everyone's situation is going to be different, and what was worked for us might not work for you, and it might work for you to go down the investment route, not the asset finance route or any other route for that matter.
Depends on your plans. Depends on what your vision is. We're still very much in grow the business organically mindset. You never know. George might wake up tomorrow and go, I want to take over. I want to take over the UK with storage sites. You know, when you've got ambitions like that, things will change.
Absolutely.
You know, that's probably the point where we go, right, let's look at different ways to fund this, you know?
Yeah.
But yeah, I think that's a good way to wrap it up. This episode, I think that covers most of it. You just basically listened to me waffle about money and finance and spreadsheets for 30, 40 minutes.
It's important stuff, though. It's important stuff.
Very important stuff.
Yeah, it's very underrated, very underheard, very underlistened, if that makes sense. But it's not necessarily something that's my skill set. I think it is your skill set, which is amazing. And it's been a pleasure to have. There's no way I would have done any of it, basically.
Yeah, well, I mean, it's just. I think it's a case of, but that's why this works. That's why this works. We have skill sets that balance and complement each other. Yeah. So what are we gonna talk about on the next episode? So episode 5.
I feel like we should start talking about some of the software updates we've done, management software in that respect.
Big overhaul. We did a big overhaul on how we manage the business, how we run the business day to day. Right.
Went from a spreadsheet on Google Drives to chasing people for money every month to now it just becoming slightly automated. Would you say? It's moving that
fully
way.
automated.
Fully automated. Yeah.
It's more or less fully automated.
So that's next episode. We should go through that.
Yeah, that'll be the next episode. So thank you very much for listening to me waffle on about money and finances and spreadsheets for this episode. Next episode, we're going to talk about hands-on stuff. Management. This has been episode 4 of The Storage Hustle. Join us next time.